Welcome to this edition of World Business Commentary. My name is Belinda Boggs and my co-host is Kristen Ciccarello. Today's edition of our show is about the Fed and its tendency to create boom and bust cycles. This has been a hot topic for a very long time. Some have called for an end to the Fed, while others simply want the Fed to change its policies a bit. Kristen, can you shed some light on this topic? Many of us have lived through several boom and bust cycles. We know about the dot-com bust around the turn of the century, the expansionary period between that and the 2008 Great Recession, the long slow recovery that followed, then the expansionary period leading up to the pandemic, and then, of course, that leads us to today's question. We had a mini bust during the pandemic and now are we to expect a big recession?
Absolutely. Let's start with Investopedia, which states, quote, "The boom and bust cycle is a key characteristic of capitalist economies and is sometimes synonymous with the business cycle. During the boom, the economy grows, jobs are plentiful, and the market brings high returns to investors. In the subsequent bust, the economy shrinks, people lose their jobs, and investors lose money." Unquote. So, Investopedia is saying that boom and bust is a characteristic of capitalism. There are two models that are most famous, referred to as the plucking model and the natural model. In 1964, Milton Friedman, the 20th century's most famous economist, theorized what is referred to as the plucking model. The plucking model says that recessions are not dependent on the size of the preceding booms but are mainly the result of infrequent events, such as financial crises. Like a guitar string, the harder the string is plucked down, the faster it should come back up. Bigger recessions should lead to faster growth rates during the recoveries, to get the economy back to the pre-recession level of activity. The size of the recession predicts the growth rate of the recovery. Most economists disagree with Friedman's model. They believe in the so-called natural model or natural rate theory. According to the natural rate theory, output fluctuates around an equilibrium trend. This equilibrium or natural level, represented by the blue line on the chart, is consistent with an inflation rate that is neither collapsing nor exploding. An overheating economy producing more than its natural level will experience inflation, and conversely, persistent spare capacity will start to push prices in the other direction, creating recession.
Interesting. So, which theory is correct?
Remember that economics is a social science. It's not like engineering or physics or something like that. So, in truth, no one knows which one is correct, or if both of them are incorrect. But I am partial to the plucking theory. Here's why. If you look at the causes of downturns, they always seem to correspond to a financial crisis, and most of these seem to be brought on by the Federal Reserve and its policies. Since 1980, every downturn has been brought on by Fed hikes with the exception of the 2020 downturn, which was brought on by the shutdown as a response to the pandemic. Even the 2020 recession sort of supports the plucking theory. It was brought on by a crisis, and its size had nothing to do with the previous expansion. By the way, for you out there watching on YouTube, if you like what you've heard so far, please subscribe to our channel and give us a big thumbs up.
Great. That was a great explanation. Now let's talk some more about the Fed's influence on recessions. Very often, it seems that the Fed creates so-called bubbles by lowering rates and creating easy money, and then deflates the bubbles by raising interest rates.
That's exactly what I'm talking about. Let's take a look at this article from the Foundation for Economic Education. Quote, "Since its founding, the Federal Reserve has had a hand in creating some of the largest bubbles in history. When the bank lowers interest rates, there is excess cash in the economy, making it relatively cheap for anyone to borrow. This creates malinvestment in the economy because while not everyone has profitable ideas, many more people can borrow, causing a bubble to form. Once the economy is deemed to be overheating, the bank raises interest rates. This forces the bubble to burst, and an economic downturn follows as a great deal of the malinvestment goes bust and people cannot borrow as cheaply anymore. To foster recovery, the Fed lowers rates again to boost investment, causing the entire cycle to repeat."
Excellent. Now, let's bring it to today. Is the Fed about to burst a bubble? Are we going to experience a bust?
Great question. I saw a Business Insider article that referred to today's situation as an everything bubble. Let's define the two most commonly discussed bubbles. 1. The housing bubble. Housing prices rose 40% from 2020 to 2022. Is this a bubble that's about to burst? 2. The stock market bubble. Will we see a major drop in the Dow, Nasdaq, and S&P 500 soon? Now, there can be other asset bubbles as well, such as cryptocurrency and even gold, to mention just two.
That's interesting. So, what do you think? Is the Fed about to burst these bubbles?
I think everyone agrees that they are trying to do so. One quote that stands out from Fed Chairman Jerome Powell himself is regarding the reset he wants to create. Quote, "The U.S. housing market will slip into a difficult correction." Unquote. So, clearly Powell wants to burst what he perceives as a bubble.
But, didn't he create the bubble?
Well, there is a school of thought that says, yes, the Fed creates and then deflates bubbles. When they lower interest rates to zero and flood the economy with easy money, this tends to create a bubble with a growth rate that is unsustainable, and this is when inflation typically occurs. When inflation increases, the Fed increases rates. Increasing rates then lead to a recession. As I've mentioned in a previous episode, many, including Milton Friedman and most economists, believe that this is how the Fed caused the Great Depression.
But, do you agree with that idea? That the Fed creates booms and busts? And if so, do you expect a recession in 2023?
Yes, I do think that the Fed tends to create boom and bust cycles. Like I said earlier, each of the major recessions were preceded by major Fed interest rate hikes. If we don't have a recession starting sometime in the next 12 months, I would be surprised.
Okay, so can anything be done to avoid a recession at this point?
Honestly, I doubt it. However, if you remember my ideas from a previous episode, I think a recession could have been avoided if the focus had been more on the supply issues rather than reducing demand.
Can you just summarize for our audience what you talked about in that segment?
Of course. If we look at the labor market and the housing market, there are serious supply issues. The labor force is smaller than it was prior to the pandemic. I won't get into the reasons for this since we talked about it extensively on our show when we discussed the question of what happened to the labor force. Regarding the housing market, builders have not kept up with housing demand since the Great Recession, and the supply is just not there. What we need to do is address these issues with policies such as reduced regulation rather than increasing interest rates. Increasing rates will actually hurt supply by making business investment more difficult. You will have less business expansion and less construction, not more.
Awesome. I really think you're on to something. Now, to summarize today's show, we defined the boom and bust cycle and offered two theories, the natural model and the plucking model. We then talked about the Fed's role in creating and bursting bubbles, and, finally, we offered an alternative approach to the current one. Regarding a recession, Kristen believes a recession is inevitable, based on history and specifically the amount of interest rate hikes there have been to date. That's our segment for today. Thanks for watching, and please subscribe and like this video if you enjoyed it.